Here's a rewritten version of your script, expanded into a longer, smoother, and more polished narrative. It maintains the core ideas and tone of critical commentary while presenting the information in a clearer, more structured style, ideal for a professional news delivery or a written article. Wall Street traders have developed a new acronym, equal parts mockery and money-making strategy, that captures how they've learned to exploit the unpredictability of former President Donald Trump. They call it TACO, which stands for Trump Always Chickens Out. It's a term that reflects a now familiar cycle. Trump makes a bombastic announcement that rattles the markets, only to reverse course days later. And savvy traders? They've learned how to profit from the chaos. This isn't just a joke passed around trading desks, it's a working strategy. Traders who adopt the TACO mindset are betting that whenever Trump makes a threat, be it tariffs, sanctions, or policy shifts, he'll eventually back off. That's exactly what happened over the past week, providing a textbook example of how the TACO strategy plays out in real time. Last Friday, before markets opened, Trump announced a sweeping new tariff, a 50% tax on all goods coming from the European Union, set to take effect on June 1st. Markets reacted instantly. Stock futures tumbled, the bond market took a hit, and traders braced for impact. But just 2 days later, on Sunday, Trump changed his tune. He said he had a good call with EU leaders and decided to delay the tariff until at least July 9th, if it happens at all. Because markets were closed Monday for Memorial Day, Tuesday became the real test. And as expected, when the markets reopened, they rebounded sharply. Investors who had followed the TACO logic, buying up cheap stocks after Friday's dip, reaped major gains. They had bet correctly that Trump's initial threat wouldn't stick. This cycle has played out dozens of times, more than 50 by some traders' count. The formula is simple. Trump makes a dramatic statement that jolts the market, waits for a reaction, and then reverses course, usually without warning. The result is a predictable loop of volatility that experienced traders can now anticipate and exploit. And while many on Wall Street are profiting from the pattern, the ethical questions it raises are serious. At its core, this is a form of market manipulation, intentional or not. When a public official makes policy threats that move markets, then backtracks days later, it creates an environment ripe for abuse. Especially when some of the people with access to that information aren't just traders, they're lawmakers. Members of Congress, for example, often trade stocks with suspiciously well-timed precision. If a lawmaker happens to hear about an upcoming Trump announcement, perhaps through a private meeting or offhand comment, they can act before the public is even aware. That's not just unethical, it meets the definition of insider trading. And yet, no one is stopping it. The regulatory bodies tasked with policing this kind of behavior have been gutted. Many key oversight roles have been left vacant or filled with loyalists who show little interest in enforcement. Even when lawmakers have been credibly accused of insider trading, consequences are rare. In some cases, investigations are never even launched. The tools we once had to hold people accountable have been systematically dismantled. And that, critics argue, is no accident. It's not just that the system has been weakened. It's that those in power seem to prefer it that way. With regulators sidelined, the wealthy and well-connected are free to profit from chaos, while everyday Americans